Welcome to Private Equity Profits. Clifford Locks is a certified board of director, a trusted confidant to CEOs, C-level exec, and high-potential employees to help them clarify goals, unlock their potential, and create actionable strategic plans. Seth Green is the nation's foremost authority on growing your business. He is the founder of the direct response marketing firm Market Domination LLC, and he is an 8-time best-selling author who has been interviewed on NBC, CBS, Forbes, Inc., CBS Money Watch, and many more. Cliff and Seth interview top players in the financial sector, focusing on private equity and real estate funds, discussing developments and trends shaping the industry. These experts will share with you how they've leveraged the power of equity funding to grow their businesses and increase profits, and how you can too. And now, here's your host, Cliff Locks.
Welcome to the Private Equity Profit Podcast. I'm Cliff Locks, your host, and with me today is Michael Livian, the founder and CEO of Livian Company, an investment and wealth management company. Michael, tell us a bit about your background and how you got started.
Hi, Cliff. Thank you for having me on your show. Very excited to be here today. Started actually in a different country. I was born in the US, but raised in Europe. That's where I started my career, and I moved to the US about 20 years ago. I started working for a big Wall Street firm, and I was more of an academic. I published a book, Italian publishing company of Bloomberg, and I was working with universities. I was very involved in the fixed income space, and then I transitioned more to the venture capital and private equity space. And in 2004, I was hired to run the asset management of a Swiss private bank here in the United States. And after several years of being involved with wealth individuals in the asset management industry, I decided to start my own firm with some partners, large caliber, large family offices. And that's how I got started. The idea was to create an innovative business that caters to the needs or modern needs of wealthy families and business owners. And since then, it's been a phenomenal journey.
Fantastic. I'm glad you're helping a lot of family offices to be able to help their high net worth individuals that are part of their team. So I'm assuming you're also doing multifamily offices and then single family offices.
Among others, yes. So
Excellent.
It's multifamily offices, single family offices, large wealth individuals. That's my basic clientele.
How do you help your clients achieve combining investing with purpose and fulfillment?
Well, it's, I think, understanding what wealth is for a wealth individual or for a wealthy family is it's a multi-pronged exercise. It's not only about the money and your returns. Mm-hmm. I think the wealthier people get and the more complex needs become, and the larger are the families, the discourse is elevated more to what the values are, what the purpose of that family or that individual is in life, what the legacy that they want to leave behind them is. So we work through several assessments and help our clients. Not every client is a good candidate, but many clients, they really want to address those type of issues. And more what we are seeing is there's an alignment between their values and purpose in life, and also the way they want to invest their funds. And yeah.
So in other words, ESG is playing a role now.
Yeah, ESG. I think ESG is it's definitely. I think it's an acronym that has a big appeal on people. I think that it's aligning the values. So ESG, it may be everything and nothing. It depends what you include and how you define ESG. But it's really defining what the purpose is, for that family or that individual, and investing in a way that is consistent with that. So it's different families have different views and different interests, and it's a transition. Not everybody is like that. Some people are still really looking just at rates of return. They're not looking at making an impact. But I think that the way we look at this, we've been doing a lot of work and following the research of Fidelity and Bain and Company, and having been discussing this for many years with a lot of professionals. What we see changing is it's for those people that actually studied business in school. And if you think of the Maslow tree, there's a pyramid, and the base of the pyramid are really basic needs, shelter, food. As you get more comfortable and you fulfill and meet those needs, your needs evolve, and there are different things that you're looking for in life. And the same applies to wealth. And I think that as we change, as generations change, what we've seen is that if you survey a baby boomer, for those participants to the podcast that do not know, those individuals that were born right after World War II, their needs are very different, their views, their values, than the Gen Xers and Gen Yers or millennials. Or generations that were born after 1960, they have a different view of the world. They are more less worried about their basic needs. They're, especially among wealthy people that are our clients, they're more interested about finding purpose, having more balance in their life and work, and retiring and having plans in place, and doing things that are meaningful in their life. So I think as we evolve, as a society, as an affluent society, these topics are going to become more and more relevant.
That's very interesting. In other words, when you look at we have parents, they've been successful at this point. They have the next generations, which is their children. So if you look at the time and the quality that can be put together, where they're spending knowledge and education together between the parents and the children at this point to understand their responsibilities and the wealth that's within the family that will continue as a legacy to go forward, to be able to do good and also to support the next generations at this point. So you actually spend time with the other generations, the children of that wealthy family at this point, to help them carve a plan together and be part of the fabric of what makes the family wholesome. Yes. A lot of the research that we have been reading is that there is a positive correlation between happiness of individuals in the next generation and having a sense of the history of the family and the heritage and the legacy. And creating that bridge, it's also a way to make everybody happier. It's like, so the family dynamics, when they work together with one of your team members, is actually addressed at that point, and it actually becomes a healthier and happier ecosystem, let's say, within the family at that point. Absolutely. Let me ask you a quick question. What are some of the biggest challenges your clients are facing now?
Well, I think at this specific point in time, obviously, COVID is the gigantic challenge. I would say, for some people financially, I think even very wealthy individuals that are heavily exposed to certain areas of the real estate market, I think they are a little challenged. But for most people, I think it's not even financial. It's really the level of anxiety and fear of the future, and questioning their lifestyles and where they're going to live, if they want to stay. We've seen a lot of people move around in the last year or so. It's like people that were very deeply rooted in a location, they just overnight were uprooted and they moved to a different state, so there is a lot of anxiety, and I think that that's probably today the biggest issue. But I do anticipate that with the rollout of the vaccines, these will actually pass. And I think we're closer to the end than the beginning of this problem. And so that is kind of one of the main issue. specific to the current circumstances. And then you have general issues. I think our clientele, they're mostly professional business owners, entrepreneurs. And I think that the speed of the change that technology is bringing about is displacing a lot of people. It has become increasingly more challenging, whatever industry you're in, to deal with the disruption that technology is bringing about. So that is also a big area of concern for our clients. The life cycle of products, the life cycle of their specific industry is changing, and they need to adapt. And it's I don't think that previous generations were faced with this issue. And that's another area where we actually converse with our clients, very smart people, business owners, but that they like to hear from us what we see in the marketplace. We're deeply involved with the companies of all kinds and all size, and we listen to their management calls and participate, to a lot of conferences, and get to know really what is happening in a lot of the most successful firms, and we share some of the findings with our business owner clients.
Very, very good. I sit on the board of directors of 5 companies, and I'm finding the same type of disruption that takes place at this point. Most of the companies are more entrepreneurial in their understanding is we have to disrupt ourselves at this point before you get disrupted. What we're finding, some of the technology that's out there, in hydrogen, some medical appliances, things, some of it's, many decades old, the technology. It's had incremental increases, but not exponential type of increase in renewing what that engineering looks like inside those products. And we're finding it's the entrepreneurs that are disrupting, these organizations. But you brought up something very, very important. The conferences, maybe the Zoom calls that are out there at this point in time is a way to get educated. And I think to be proactive at this point.
I'm very optimistic about the future. I do think that whatever is going on today in the world and with technology and digitization of almost every process offers an opportunity for people to improve and not to be displaced by technology. Because I think that as humans, we're always going to be superior. And so it's just about educating ourselves and upgrading our knowledge and our skills.
I think you're brilliant. I think you laid that out very, very nicely. The idea of the individual and those that own the companies need to take the initiative to understand we're going to need to re-educate the workforce. Some of the manufacturing may have something called a cobot, meaning there's a robot, but the individual's working next to it. The robot's doing a lot of the menial, repeatable tasks, but they can coexist together, and someone's going to have to program and keep an eye on and run those robots at that point. It's probably a technician at that point, which will get paid more than somebody, running on the line. So let me ask you, what does the growth of the alternative investment industry look like from your perspective?
It's a very, very, very good and interesting question. First of all, I think that it is important to define the alternative investment space. I think that again, I think it's easy to put a label on something, but what is alternative? Is it real estate, venture capital, private equity, hedge funds, commodities, cryptocurrency? What is it that is included in the definition? And I think that each subcategory of what you may define alternative investments, they have certainly different path in their evolution. I think that, first of all, the fact that you're in an environment where structurally interest rates are low, despite the short-term gyrations that you may have had recently with the 10-year treasury, you are still in a low interest rate environment. And you are in an environment where valuations in the public markets are pretty high. So there is a very large demand for alternative assets in general, and I think that's going to continue. and I think it is going to evolve. Having said that, I do believe that within the alternative asset space, there are a lot of players that don't really deserve to be there, and there's going to be a pretty strong, so to say, natural selection and evolution. And I think that specifically, let's say, any person can start a hedge fund. It's like, but there's not that many great hedge fund managers. I mean, it's really very few and very large. So I do think that the compensation structure in some of the hedge funds is going to change.
Okay.
It has started to change. I think there's going to be more consolidation, and I think that there's always going to be a big appeal, but I think it's going to look hedge fund industry is going to look very different in the future. I do think in the private capital markets, both private equity and private credit, you still have tremendous opportunities. In a way, becoming also more liquid. There are marketplaces where you can exchange positions and loans, and you have a lot of participants, and you may get higher rates. Speaks still very highly of subsectors of the alternative space. And then I can go on, but I think probably these are the broadest categories. Consolidation in the hedge fund world, still expansion in private equity, VC, private credit. As long as credit remains cheap and available, you're not going to have a lot of hiccups there. But again, private markets are heavily dependent on credit. And we are, I would say, in an expansionary phase for credit, but this is not going to last forever. So I think it's important to be very wise as an investor when you approach the space.
Recognizing there's a pressure to put money to work in the 5-year private equity cycle, what industries or strategies do you think make the most sense right now?
Clearly, I think what we have seen in the last year is a strong demonstration, healthcare, biotech, and life sciences space. There are phenomenal opportunities. It's an industry that still offers a lot of opportunities for extra returns or additional returns, because it's a little bit behind the other industries when it comes to the innovation, other than the pharmaceutical sector in particular, or the life science or the biotech. But the healthcare sector as a whole, because it is heavily regulated, it has not evolved as fast as a lot of other areas. So the technology there can really create a lot of incremental returns, and there's a lot of opportunities there. I think that's certainly a very important area. So if you think of the two areas that you have a lot of regulation that kind of slows down the evolution of an industry, there are these two giant areas. You have healthcare and the financial sector. So I think they both are probably in the early cycles of a massive evolution, and that offers obviously opportunities for returns for investors. So it's I would say probably a little bit more between the VC and the private equity, not your classic private equity leverage buyout. I do think also when it comes to the private equity space, logistic and infrastructure space offers incredible opportunities. I think, again, in the US, the percentage of e-commerce in retail sales is still pretty small compared to the entire pool of retail sales that are happening. And I do think that the backbone of e-commerce is really the logistic. That's storage facilities and transportation. So those are kind of assets that generally offer good cash flows, and they're pretty stable, and they have potential good growth rates. And I think those are private equity investors, the ideal candidates. You can lever them up and increase your rates of return. So those are the main things that come to mind, but there's obviously a lot of other areas of interest. I think it depends also on the style and appetite of the private equity operator.
Help me a little bit. What credit ratios do you look at when assessing the financial health of a borrower?
This plays in area of great interest for us. We look combination of purely quantitative metrics that we can pull from the balance sheets. And I think we have a very close relationship with the NYU professor or former professor Ed Altman, that is a dear personal friend of mine, and developed a Z-score model.
Excellent.
So we use his model with many other evolutions. There's another academic by the name of Campbell that has developed other tools. So they give us a little bit a more holistic sense of the health of a firm. Then obviously, alongside those are, I think, they give you much better probability of default. But alongside those, what we use are more traditional metrics. So we use EBITDA ratios, debt to EBIT ratios, debt to assets, debt to capital. Obviously, we normalize the cash flows. We look at the kind of averages over time. We look at peers. So there's a number of things that go into that. And most recently, we have not utilized these tools yet, but we are working closely with some fintech companies.
Okay.
They are doing a lot of interesting work. I think that they are providing their accounting solutions to companies, and they pull the data almost instantaneously from their accounting systems and from their bank accounts. And they can actually, in real time, look at the evolution and credit worthiness of the borrower. And they even lend to borrowers based on those metrics. And so there's a lot of old school classic stuff that goes into the analysis of the credit analysis for a borrower or an issuer. But there's more and more exciting stuff that is also coming online now.
Very, very positive. And I've seen one of my companies is utilizing those lines of credit. In other words, we're on Walmart.com, doing hundreds of thousands of dollars a week. And that line of credit was very, very important to be able to allow the continual growth in that particular market. So, and yes, they have access to our bank accounts and they understand the cash flow that's coming from Walmart into our accounts and they lend against it. So it maps up very, very nicely. Michael, what are some of the red flags you would look out for when assessing a potential investment opportunity?
Red flags. I think that first of all, what we have learned after many years of dealing with borrowers, companies, and management and investments, is that probably the most important aspect that you want to look at when you evaluate a business or an opportunity is actually the industry and the industry dynamics.
Okay.
It's not focusing on the specific product or the management of the company, but the first thing that we would do to identify if there are red flags, we're just going to look at the industry dynamic. How does this industry look like? In which direction is it going? Is it growing? I mean, how many participants are here? Is it prone to changes and disruptions? Are the companies that we're looking at on top of their game or they're behind? So it's not really a red flag, but that's contextual. I mean, if an industry is going in the wrong direction, we're not going to put money behind it. Now, red flags is first, you start with the management. I mean, you want to have credible management that is honest, transparent, has the right incentives, communicates with investors, sets proper goals and shows a track record of achievement. When they fail to do that or they're not transparent, that is already to us. And then you have a number of accounting metrics. If you have big discrepancies between earnings and cash flows, that is typically a red flag. It's like so I think it's not that difficult, but there are tools that we have available at our disposal when we look at the accounts to see if things are off. Revenue recognition, discrepancy between cash flows and earnings, depending on the specific industry, the working capital cycle starts to look off. I mean, you can start to pinpoint, but I think that before you look at the financials, you want to look at the business and the management. The financials are a consequence of what the management is and the business is. If you have a poor management, low quality management, to us, it's enough of a red flag.
Very, very good. Well, a seasoned team is very, very important to have consistent results and maybe serial exits. Maybe they've built and sold a few companies. Let's look at some of the value your fine team brings forth. In other words, we've got a high net worth individual. They probably have a business that they're running at this point. They are starting to get into their 50s, 60s. They need to look at succession planning. Do I continue to prepare the company to be able to be sold? Am I going to turn the business over to maybe one of my children? Am I going to bring somebody from the outside to run the company? Tell me more about your process to be able to help these high net worth individuals make these strategic decisions they need to make.
Look, I think this is a topic, again, that I have very close to my heart, because approached by some strategic buyers. And, we are in a business that generates nice, steady cash flows. And I asked the same questions to myself. I said, where do I stand? I mean, do I want to build this business for my children? Do I want to pass it on to them? I mean, what's the end game? And it's and I got involved in an institute that is known as the Exit Planning Institute. And I found out there is a science behind exit planning, building value for a firm, for business owners, medium-sized, small-sized business owners. And I came to the realization a very, very large chunk of the businesses in the United States are owned by private individuals, and that they are in their early 60s, almost, I would say 75, 80%, I don't remember exactly the statistics, they expressed an interest to retire within the next 10 years. But if you ask them if they do have a plan or a written plan, again, 80% of them, they don't have a plan. They just have an idea and a goal. And also the statistics show is most of those businesses, they end up not consuming a real transition. They actually have problems before. Either there's a disability, there's some distress, there's an issue with the family. The transition does not come to fruition. We really prepared ourselves to work with clients using the science behind transition planning and the numbers and the methodology to make this successful, and to also make it an enjoyable experience for the business owner. Because also I'm quoting Price Waterhouse. They did a survey, business owners that sold their business within 12 months of the sale. And a very large number of those business owners, they say they profoundly regret selling the business. Transitioning out of the business, whether it's an external transition, it's a sale, or passing the business on to a partner or to the children, it requires three things. It requires emotional preparation.
Right.
I think people do not realize that, you spend a lifetime building a business and you've been running every day and, getting excited, dealing with problems, clients, making money. And all of a sudden you sell this. I mean, your purpose is gone. You are your business if you're a business owner. So there is some preparation that goes into that. The financial component, I think that many business owners are not aware of the structure of the transactions, how much they may get out of the transaction, the tax implications, the state implications. So all of these things need to be handled and prepared before you transition, not while you're transitioning. And lastly, I think the majority of business owners don't really know they have an idea of what the value of their business is,
right,
but they do not know really how much they can increase the value of their business and how much they can get in a transaction. So these three prongs are the foundations of a plan.
I think that's very, very important. I mean, I've had the privilege of building 3 companies with successful exits, and it was a plan, and there were advisors involved, fine folks like yourself that helped guide me through that process. And it was a privilege to work with them. It was emotional. My last transaction, I sold the company to KKR, which is a large venture company, and I became part of a Fortune 500 company, which was something new to me versus being entrepreneurial. And then we had the ability to add additional assets. And then we sold the company again for $1.2 billion in cash. So when you look at things, it's a process for the entrepreneur, and then the opportunity to want to stay with the acquiring company for a period of time. In my case, I stayed for 18 months contractually, and then go on and do something different. The tax implications, those were very, very large checks that had to get written, and they need to get planned for.
Absolutely. You're absolutely right. 100% right. I think that what typically happens is that when you come to the deal table, the seller just feels very frustrated and pulls out, because they just didn't realize that most transactions, you have an earnout, you have seller's financing, you have taxes, you have commissions. If you do asset sale, you may be penalized. And they get very frustrated, and they boils up to the point that they may go to that table when they need to sign, and you just decide to take a walk and leave the negotiation and the deal. So
very interesting.
yeah.
I'm on the another one now. I'm working with young people, and we're doing the acquiring side, and we're finding ability to stay very friendly with the seller and understand what their needs are. You bring up something very, very important. See this on your website, know your gaps. The 3 numbers you should know and manage to achieve your goal. That lays out a very positive scenario. And I'd like to go into depth with a little bit from yourself, where this conversation really needs to happen with the seller at this point, because you don't want buyer, remorse, let's say, and the seller remorse you don't want. Having these conversations where the funds are going to go and understanding the period of time for the transition between the seller and the buyer. And maybe the seller becomes one of the board members, or maybe they leave some equity in the company. Understanding each other's needs, I think, can allow that transaction to flourish. So tell me more about the know your gaps.
I think as a very successful business person yourself, you know how the mind of a business owner works. I think that you need to always simplify things, have clear numbers, clear things in your mind. That's really how we need to have. We cannot deal with uncertainty and confusion. Our mind always wants to have certainty, even if it's the wrong certainty. Facilitate the process of a business owner transitioning. I think there are 3 fundamental gaps that they should really have straight in front of their eyes all the time. And they can be numerically calculated. They're extremely important. Mm-hmm. The first one is what we call the wealth gap. So the wealth gap is essentially what financial planners use all the time, is how much money do I need to live my life the way I want to live it. Pretty easy to calculate with some actuarial simulations. The second component of that calculation is how much do I have today that is liquid and investable that can get me there. The vast majority of the times, there's a giant gap between the two, especially for business owners. The element that was going to fill in that gap is the value of the business.
Very good.
So essentially, if you want to get to a point where you're comfortable and you know that you can really go on with your life and do whatever you want in peace, you need to make sure that that gap is filled by the value of your business. After tax, after transaction costs, if you do an exit, and that's really what you are working towards. Now, this leads to the second part, which is what is the value of the business? Is it sufficient? Can I grow it enough to act as a plug to kind of close that wealth gap? So there's 2 components that you want to evaluate. One is a profit gap, and then you have a value gap. So what are these gaps? Today, luckily, we have a lot of tools and technology and databases, also in the private markets, as opposed to the public markets, where you can benchmark your business. So the income gap essentially is a measure of the difference between, if you take the best-in-class company in your specific sector and yourself, what is your EBITDA margin or adjusted or recast EBITDA? You want to make sure in the private business world, you need to make some adjustments. It's not like in the public markets. So you need to add back certain numbers, remove them. So you need to fix calculation for your EBITDA. But what you're looking at is, what is my EBITDA margin on the revenues that I have? And what is the EBITDA margin of the best-in-class company? And then I think part of the exercise is to see what levers do I have to increase the profitability of my business. That's kind of part of the exercise of accelerating build up in value in your business. But it's a number that you should know, as I think that when you have numbers in front of you, it gives you different motivation. It's not an idea, it's not a concept. You can compare, say, you know what, my EBITDA margin is like 15%. The best in class companies, their EBITDA is 25%. Maybe I can increase my profitability by 5% by doing this. And lastly, is your value gap is essentially the value, the best in class company in the same sector, same type of business. If you apply a multiple to their EBITDA, and if you apply a multiple to your EBITDA, you can calculate the difference using the same level of sales. So if you have best in class margins and best-in-class multiples, and you have your multiple and your margins. That gives you an idea of how much value creation you could aspire to achieve, get to that point. Ultimately, if there's sufficient money to close your wealth gap. So these three elements together, they work as a foundation to build a plan. They give you the right motivation, but also the right tools then to go deeper into some assessment and analysis at the business level, as a personal finance level, and see, how you can adjust. I think it's very important to start with simple, clean, good numbers. I think when business owners see these things, they're like, wow, all right, now I know what I need to do, and let's work on this, and let's work. And there's a whole process behind this, build all the different plans to close those value gaps and those income gaps and those wealth gaps.
Very, very comprehensive. I mean, you bring forth a lot of wealth of knowledge for that high net worth individual to really understand a vision of what success looks like, as they continue to age and they got to make some decisions with their business. It would be very, very positive for our listeners to partner with you. Michael, what do you love about what you do? And what do you find most rewarding personally?
It's a very good question. There's two things that I always loved, and I think that's why I went into this profession. I have a deep intellectual curiosity. I like numbers. I like concepts, ideas, businesses. I like studying and researching. In fact, my family makes fun of me. They say I should be an academic. I should be teaching stuff, because I really love learning. And I think being in the finance sector, it allows me to learn every day more. I mean, there's so much we can learn on the quantitative side, on the analytical side, on the research side, on the tax side. There's so much you continuously learn and learn and learn. And I really enjoy it, and I can share it obviously with my clients. So this is one thing that I like. Really makes me happy, that because of the person I am, I really get enormous satisfaction when I can help people and I do something meaningful for them. And we have all sorts of people, all sorts of clients. We do get often people, we make a big change in their life, very happy, and they're very grateful. The reward that I get from that is priceless. It's not a monetary reward. It's like, I feel like really I did accomplish something, somebody that had some issues and they need to fix things, and they had that. And they're just grateful, that I helped them out, or we helped them out as a team. I'm not alone.
I see you and your team cares about their investor. Now with COVID-19, some of the economic disruptions, tell our listeners about the program that provides an objective second opinion from your trusted and professional team. I heard there's no fees, no stress, no obligations. Things
now are a little bit better. And obviously I'm very happy that got out of the stressful times that we experienced at the beginning of COVID. For many people, this was just a catastrophic event that came out of nowhere. I think it was the economy was doing perfectly fine. Everything was doing perfectly fine. All of a sudden, you are faced with issues and problems that seem unsurmountable. You cannot walk out of your house. You cannot walk out of your apartment. You think you're extremely wealthy because you own a nice office building downtown, and all of a sudden you don't have tenants. You have a hotel and, they force you to shut it down. A lot of people, their life changed overnight. We offered early days our services for free, to not all our services, but at least an initial review and assessment of the financial situation of some of our clients. We offered them a free consultation to see where they stood, how they were invested, if they had the proper investment plans, if we're benefiting from all of the things that our government has been extending to people. So we just wanted to assist people. I truly appreciate you spending this quality educational time with our listeners today, Michael. It is my pleasure, Cliff.
Michael, can I share your contact information with our listeners?
Please. Yeah, absolutely.
You can reach Michael Livian. His email is at mlivian@livianco.com. LivianCo.com is spelled LIVIANCO.com. That's LIVIANCO.com. And you can also reach Michael at 212-319-8900. Again, Michael's phone number is 212-319-8900. Thank you to our listeners. I look forward to being back with you shortly for another episode of the Private Equity Profits Podcast. The show has been produced by Market Domination, LLC. And I'll see you next time. This is Cliff Locks.
Thank you very much. Bye-bye.